Silver is at 86.05 on your screen right now, down 3.54 on the day, down 3.95% in a single session. And the financial press is already constructing the explanation you're going to hear for the rest of this afternoon. They are going to say it was the CPI. They are going to say inflation came in at 2.4% annually, exactly in line with expectations, and that the Fed is holding rates at its March 18th meeting. They are going to frame a $3.54 paper price drop as evidence of rational market repricing. They are going to deliver that explanation with charts, with credentials, and with complete confidence. And while that explanation is being assembled for public consumption, something happened today at the largest asset management institution in the history of capital markets that tells a completely different story about this metal and about what this price drop actually means. Kristy Akullian, head of iShares investment strategy for the Americas at BlackRock, the firm that manages more money than the GDP of Japan. Today, the same day the CPI prints and silver gets hammered 3.95%, she published an institutional analysis of precious metals that was not written for retail investors. It was written for clients who redirect billions of dollars with a single portfolio decision, and that analysis does not say what you're hearing on television right now. It says the demand backdrop for precious metals is constructive. It says gold and silver can serve as portfolio differentiators and as exposure to long-term structural demand simultaneously. It says the drivers that fueled 2025's remarkable returns remain in place. Same market, same Wednesday. Two completely different messages traveling in opposite directions to two different audiences. The public gets the CPI headline and a 3.95% paper price drop. Billion-dollar clients get a structural case document confirming that the physical demand architecture underneath this metal has not changed because of today's inflation print. I am going to show you exactly what BlackRock told its wealthiest clients today. I am going to show you the three structural catalysts the memo identifies, and I am going to be completely honest about what the bear case looks like, because there is a real version of this story where the paper price is more right than the BlackRock analysis suggests. This is financial warfare education, not advice. Let me show you what the data actually says. Segment 1. Confirmed facts. Wednesday, March 11th, 2026. Let me start with confirmed facts as of this morning, because on a day with this much noise, separating confirmed from narrative is the most important thing you can do. Confirmed. February CPI released this morning at 8:30 a.m. Eastern. Headline CPI up 0.3% month over month, 2.4% year over year. Core CPI up 0.2% month over month, 2.5% year over year. Both figures exactly in line with Wall Street consensus expectations. Not a hot print, not a cold print. Exactly what was forecast. Confirmed. Silver spot price as of this morning, 86.05 per ounce, down 3.54, a 3.95% decline on the day. Gold is trading at $5,187.60, down 54.50, a 1.04% decline. Silver's steeper percentage decline pushed the gold to silver ratio to 60.3. Silver is underperforming gold in today's session, a pattern the data describes as common in risk-off sessions when speculative positioning unwinds faster in the secondary metal. Confirmed. Fed meeting, March 18th, 1 week away. Current market pricing assigns nearly 100% probability that the Fed holds rates unchanged. Confirmed. Kristy Akullian, head of iShares investment strategy for the Americas at BlackRock, published an institutional precious metals analysis today, the same day as the CPI release, titled around the question, "After a record run and a sharp decline, where do precious metals go from here?" The document was published on BlackRock's official institutional research platform. Confirmed. February CPI report predates the oil shock from the Iran war. The report measures prices through February, before the U.S.-Israel strikes on Iran that pushed crude oil sharply higher. As Kiplinger notes in its March 11th coverage, any impact from higher energy costs will likely show up in March CPI data, not today's February reading. Today's CPI is backward-looking. The inflation story it cannot yet measure is building in the pipeline. Confirmed. China's February factory gate prices for silver refining surged 16.9% year over year. Gold refining costs jumped 8.4% year over year. These are not spot price moves. They are the cost to physically process and refine metal inside China's industrial supply chain, the world's largest silver processing nation. Confirmed. Silver has gained more than 22% since the beginning of 2026, even after today's decline. It has gained more than $53 per ounce over the past 12 months. Those are the confirmed facts. Everything after this is analysis. The distinction matters today more than almost any other day this year. Segment 2. What the BlackRock analysis actually says. Let me be precise about what Akullian published today. because the way institutional research gets translated into public headlines strips out the substance that makes it meaningful. The document opens with a direct question. After silver's 148% gain in 2025, after gold's 75% advance and its crossing of $5,000 per ounce for the first time in history, after the violent January crash from 121.67 to 75, where do these metals go from here? Akullian's framing for billion-dollar clients before presenting her structural case. Silver's volatility has jumped 106% year to date. Gold volatility is up 46%. Her word for this market, powerful. Her word for the risk profile, real. That is the institutional framing. Not panic, not a top signal. Powerful market, real risk profile, and a structural case for why the demand backdrop remains constructive. The document identifies three forces that make it, in her language, mathematically implausible for precious metals to behave the way the paper price is suggesting they behave today. Three structural catalysts. None of them are technical, none of them are seasonal, none of them are CPI dependent. They are structural, they are long duration, and the data confirms they are accelerating. Let me take you through each one. Segment 3, Catalyst 1, sovereign debt at 120% of GDP. The first catalyst is the condition that most retail investors understand conceptually, but resist accepting at the scale it has actually reached. The BlackRock analysis confirms that the United States federal government is carrying debt that has crossed 120% of gross domestic product, annual deficits running between 6 and 7% of GDP. And Akullian makes clear in the document that this is not a uniquely American problem. Japan, the United Kingdom, France, Canada. The debt saturation is systemic across every major developed economy simultaneously. Here's what that means in operational terms at the level BlackRock is describing it. An increasing share of new government borrowing is not funding programs or infrastructure. It is funding the interest payments on debt that already exists. The government is taking on new debt to service old debt. That is the mechanical definition of a debt spiral, and once a sovereign debt spiral reaches the scale the BlackRock document is confirming across multiple reserve currency economies simultaneously, the available resolutions narrow to three: default, restructuring, or currency devaluation. Democratic governments with global reserve currencies do not default publicly, they devalue, slowly, then faster. The BlackRock analysis notes that gold has historically benefited in these environments, and that silver has often behaved as a higher beta extension of the same theme. When the store of value case for precious metals strengthens at the sovereign debt level, silver amplifies gold's move. The upside in a debt-driven metals bull market has historically been larger for silver than for gold, precisely because of that amplification characteristic. This is not a new argument. What is new is that it is being confirmed in institutional language by the largest asset manager in the world. On the same day the paper price drops 3.95% on a CPI print that tells us nothing about the inflation that is building in the pipeline from a $119 oil environment that February's data does not yet capture. Segment 4, Catalyst 2. Central banks are replacing U.S. Treasuries with gold. The second catalyst is what makes the current precious metals cycle structurally different from every previous one in the modern era. Central banks hold approximately 20% of all mined gold ever produced, and the BlackRock analysis confirms they have been systematically adding to those holdings. A 2025 survey showed 95% of central banks expect global gold reserves to rise further in 2026, up from 81% in 2024, up from 52% in 2021. The momentum is not decelerating, it is compounding quarter by quarter. Then Akullian reports something that did not receive the weight in mainstream financial coverage that it deserves. In 2025, gold overtook U.S. Treasuries as the largest share of global reserves for the first time in 30 years. Read that again slowly. The asset that sovereign monetary institutions, the guardians of national wealth, the entities responsible for maintaining the financial stability of entire countries, trust more than United States government debt is now gold, for the first time since 1995. And the buying is not slowing. The BlackRock document identifies a specific reason why this trend has further to run. China and Brazil, two of the largest economies in the world, still hold less than 10% of their reserves in gold. Both have been actively reducing dollar-denominated reserve exposure. If those reserve allocations move toward even modest rebalancing toward historical norms, the incremental demand against a finite supply of metal is a structural price event, not a trading event, a structural event. When the entities conducting that accumulation together represent approximately half of the world's population and roughly 1/3 of global economic output, and when 95% of central banks are telling survey researchers they plan to continue accumulating, that is not a marginal positioning adjustment. That is a formal, measurable shift in what the world's monetary authorities trust to hold national wealth. The official announcement about dollar decline always comes last. It comes after the institutional repositioning is already complete. The window between the repositioning and the announcement is where the wealth transfer occurs. BlackRock is publishing this analysis because they believe we are inside that window right now. Segment 5, Catalyst 3, Industrial Demand with no off switch. The third catalyst is what makes silver specifically different from gold in this cycle, and it is confirmed in the BlackRock document with data that the paper price has not begun to reflect. Approximately 60% of annual silver consumption is tied to electronics, solar panels, and semiconductors. That is not investment demand. That is not speculative demand. That is industrial consumption that does not respond to paper price signals because the manufacturers consuming it cannot substitute away from silver on a timeline that matters to their production schedules. Electronics alone account for roughly 445 million ounces of silver demand per year, making it the single largest industrial use of the metal on Earth. Now layer on top of that baseline what Akullian describes as a potentially cyclical and growth-sensitive acceleration. The ongoing build-out of data centers, rising power demand from AI workloads, and broader electrification trends are adding a demand component that the industrial baseline does not yet fully capture. Solar photovoltaic accounted for nearly 29% of total silver industrial demand in 2024. In 2014, that figure was approximately 11%, a nearly threefold share increase in a single decade, driven by a technology that every major economy on Earth is now mandating at scale. There is no synthetic alternative that performs the same function at the required cost and conductivity level. Akullian's conclusion on this is direct. Silver's role in future technologies is expected to support structurally higher industrial consumption. Structural means the demand floor rises permanently and does not retreat when economic conditions soften. The electrification of the global economy is not a policy option at this point. It is a committed infrastructure trajectory. And silver is the material without which that trajectory cannot be executed on any timeline that existing capital commitments assume. When BlackRock frames this for clients managing billion-dollar portfolios, the conclusion is a supply-demand observation with one logical direction. Industrial demand is rising structurally. Supply of precious metals is finite. The price at 86.05 on your screen today has not begun to reflect the demand curve that is actively forming. Segment 6, the CPI number and what it is actually telling you. Let me connect today's CPI release to the BlackRock structural case, because these two things, the paper price drop and the institutional analysis, are not in conflict. They are describing the same market from two different time horizons. February CPI came in at exactly consensus. 0.3% month over month, 2.4% year over year. Core at 0.2% monthly, 2.5% annually. The market reacted with a modest dollar bounce. That dollar bounce applied suppressive pressure to the paper price of silver through the inverse relationship between dollar strength and metals prices that algorithmic futures strategies automatically execute. A 354 drop on an inline CPI print. That is the paper market mechanics. Here is what the same CPI print is not telling you. The February data predates the Iran war oil shock entirely. The U.S.-Israel strikes on Iran happened after February's price measurements were completed. The $119 crude oil environment that has been setting energy prices in March, the same oil price that is simultaneously increasing silver mining costs and threatening Strait of Hormuz supply disruptions, is not in today's report. It will be in March's CPI, released in April, after the Fed has already met and held rates on March 18th. The Kiplinger analysis of today's CPI report states it directly. The data predates the recent surge in oil prices tied to the war with Iran, meaning any impact from higher energy costs will likely show up in the months ahead. Today's CPI is a backward-looking measure of an inflation environment that no longer exists. The forward inflation picture, oil at 119, China's silver refining costs up 16.9% year over year, supply chain disruption risk from an active military conflict over the world's most important energy transit corridor, is not visible in the number that just moved the paper price of silver 3.95% lower. The paper market is repricing based on data that describes February. The physical supply chain is operating in a world that is already March. Those two things are in disagreement. And when paper and physical are in disagreement about the same commodity, one of them eventually moves to meet the other. Segment 7. The mechanical story behind today's drop. Let me show you the exact mechanism behind what you saw in the silver market today, because this is the part that the CPI narrative will not explain. A leveraged futures trader holding a long silver position on COMEX carries a margin requirement, a fraction of the total contract value. When the price of silver drops below the level that exhausts that margin buffer, the broker issues a margin call. If the trader cannot meet it immediately, the position is liquidated automatically at whatever the current market price is. That forced liquidation adds sell pressure. The additional sell pressure drops the price further. Other over-leveraged longs hit their margin thresholds. Their liquidation drops the price further still. The cascade continues in sequence until every over-leveraged position has been mechanically flushed out. This is not organic selling from physical holders who change their view on the metal. Physical holders do not have margin calls. They are not leveraged. They do not sell because an algorithm decided the paper price should be 3.95% lower on a Wednesday morning. The selling in today's session comes exclusively from leveraged paper positions being mechanically liquidated, and every forced sale in that cascade has a buyer on the other side, buying silver at prices that are temporarily below where the physical market would clear if it were setting the price for actual metal delivery. The BlackRock document is being read today by the exact institutional desks that are positioned to absorb every forced sale the CPI-triggered cascade produces. They have the analysis, they have the capital, they have the patience, and they are buying from the retail participants who are interpreting today's $3.54 drop as a fundamental signal rather than a mechanical leverage event. Here is the ground-level confirmation that the paper price and the physical market are still telling different stories. If silver were genuinely losing fundamental support, if the structural case were actually breaking down, physical premiums at retail dealers would be collapsing. You would see physical silver available near or at paper spot price. Motivated sellers trying to exit before the price falls further. That is not what is happening. Premiums on silver eagles and silver maples are not declining. Physical holders have no margin calls. They have no algorithmic stop losses. They are not leveraged, so they hold. And because they hold, the available physical supply does not increase, despite what the COMEX paper price is suggesting. Any buyer who actually wants to take delivery of real metal has to pay a premium above the suppressed paper price to find a willing seller. That spread between the paper price and what a buyer actually has to pay for physical silver is not noise. It is the physical market's verdict on the paper market's temporary disconnection from reality. Segment 8. The honest bear case. Now the other side, because this is financial warfare education, and the bear case deserves the same intellectual respect as the bull case. Bear argument 1. Inline CPI is not the story. The Fed is. March 18th. Fed meeting assigns nearly 100% probability of a hold. If the Fed holds rates longer than currently expected, if the Iran oil shock pushes March and April CPI above 3%, and the Fed is forced to signal rate hikes rather than cuts, the dollar strengthens significantly. Dollar strength is the ceiling on silver that has been operating for months. A stronger for longer Fed is the most direct threat to the paper price thesis, regardless of what the physical supply data says. Bear argument 2. The BlackRock analysis is published by an institution that manages gold ETFs and precious metals funds. BlackRock's iShares is the world's largest ETF provider. They have a direct commercial interest in institutional and retail capital flowing into precious metals products they manage. The analysis is credible and data-driven, but the incentive structure of the institution publishing it is not neutral. It deserves weight, not uncritical acceptance. Bear argument 3. Silver's 3.95% decline versus gold's 1.04% decline on the same day confirms the pattern the data describes. Silver underperforms gold in risk-off sessions because speculative positioning in silver unwinds faster than in gold. If we are entering a sustained risk-off period driven by war uncertainty, dollar strength, and Fed hold signals, silver's higher volatility works against it in the near term, even if the structural thesis remains intact for the long term. Bear argument 4. The private credit market risk that BlackRock identifies, $1.8 trillion in non-transparent private credit exposure, is real and building. But if that risk triggers a broad deleveraging event across multiple asset classes simultaneously, the short-term flush in silver could be violent before the safe haven bid reasserts itself. The same liquidity dynamic that crushed silver to $12 briefly in March 2020 before it recovered to $29 could repeat. The structural thesis survives a liquidity event. But the path through it is not comfortable for anyone holding leveraged positions. These arguments are real. Anyone positioning in silver based exclusively on the BlackRock structural case without acknowledging these risks is working from an incomplete framework. What the bear case does not resolve: the structural demand data, the central bank reserve rebalancing, the 6 consecutive years of supply deficit, and China's silver refining cost surge of 16.9% year over year. None of those variables changed today because the CPI came in at 2.4% annually instead of 2.3% or 2.5%. The paper price moved. The physical reality did not. Segment 9. 3 scenarios. Honest probability assessment. 3 scenarios for where this goes from here. Honest probability assessment on each. Scenario 1. Paper price leads, thesis delays. The Fed holds March 18th and signals a hawkish tilt due to oil-driven inflation risk. The dollar strengthens toward 100 on the DXY. Silver spends April and May in the $80 to $88 range as the structural catalysts BlackRock identifies continue building beneath the surface without yet expressing themselves in the paper price. JP Morgan's $81 annual average comes closer to right than the structural analysis suggests for the first half of 2026. The thesis is intact. The timeline extends. This is a real scenario. The mechanical conditions for it, Fed hawkishness, dollar strength, paper market suppression, are all present today. Scenario 2. Physical data overrides paper narrative. The March CPI data released in April comes in above 3% as the oil shock from the Iran conflict flows through energy prices into the broader inflation basket. The Fed faces a stagflation trap. Inflation rising while economic growth softens. That prevents rate hikes without triggering a debt service crisis on $38.5 trillion in national debt. The dollar weakens rather than strengthens as the Fed's credibility erodes. The paper price begins converging toward the physical reality that BlackRock's institutional clients are already positioning for. Silver moves from $86 toward $100 to $115 through Q2 as the ratio compresses from 60.3 toward 50. This is my current base case. The CPI pipeline data supports it. The BlackRock structural case supports it. The physical premium data supports it. Scenario 3. Structural convergence event. The March and April CPI prints confirm accelerating inflation from the oil shock. Fed independence concerns deepen. The dollar weakens structurally. COMEX registered inventory, currently at 81.2 million ounces, continues draining as March and April delivery cycles process at record levels following February's historic 25.18 million ounce delivery. The private credit stress BlackRock identifies surfaces visibly through a major hedge fund redemption event or forced liquidation across multiple asset classes. Capital floods into physical assets simultaneously from institutional, sovereign, and retail buyers, all interpreting the same data at the same time. In this scenario, the gold-to-silver ratio compresses from 60.3 toward 40 as silver's dual role as monetary and industrial metal attracts both the safe haven bid and the supply scarcity premium simultaneously. Silver targets $150 on the first structural leg. $280 follows as the ratio approaches 25. Segment 10. What to actually watch your watch list. All public, all free. Fed meeting March 18th. Statement language on inflation and rate path. Not the decision itself, that is already priced at 100% hold. The language about what comes next. Any signal of rate hikes rather than rate holds is the ceiling reinforcement. Any signal of rate cuts by June is the pressure release valve. March CPI release in April. This is the first data print that will capture the oil shock from the Iran conflict. If headline CPI moves above 2.8% to 3% due to energy costs, while core stays sticky, the stagflation signal BlackRock's sovereign debt catalyst describes becomes visible in official data. That is the moment the paper market faces the forward inflation picture it cannot currently see. BlackRock ETF flow data, iShares Silver Trust, SLV, iShares Gold Trust, IAU. Weekly flow data is publicly available. If institutional capital is flowing into these instruments while the paper price is declining, if BlackRock's own clients are buying on the same day its research team is publishing the structural case, that is the institutional confirmation of exactly what the memo describes. COMEX registered silver inventory, daily warehouse reports from CME Group. If registered inventory continues declining from 81.2 million ounces while open interest holds elevated through the April delivery cycle, the mechanical preconditions for a physical delivery squeeze are building regardless of where the paper price sits today. China refining cost data. The 16.9% year-over-year surge in silver refining costs inside China's industrial supply chain is not a mainstream data point, but it is the most direct signal available about what is happening to the physical cost structure of silver production in the world's largest processing nation. Watch for any updates to this figure in March's industrial pricing data. Physical dealer premiums, JM Bullion, APMEX, Gainesville Coins, SD Bullion. If premiums on Silver Eagles remain above $6 to $8 over spot while the paper price sits at $86, the physical market is refusing to accept the paper price as a clearing price for real metal. That refusal is the most honest signal available about where physical supply and demand actually intersect. Outro, I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Here's where the data puts us on Wednesday, March 11th, 2026. The paper market says silver is 86.05, down 3.95% on a day when February CPI came in exactly at consensus, 2.4% annually, 0.3% monthly. And the algorithmic futures market responded by selling the leveraged paper positions that could not withstand even that mild confirmation of continued inflation. At the same time, Kristy Akullian at BlackRock, managing more assets than the GDP of Japan, published an institutional analysis confirming 3 structural catalysts for precious metals that have nothing to do with today's CPI print. Sovereign debt at 120% of GDP across every major developed economy. Central banks replacing U.S. Treasuries with gold for the first time in 30 years. With 95% planning to continue in 2026. Industrial silver consumption tied to electronics, solar, and AI infrastructure that has no off switch and no economically competitive substitute. China's silver refining costs are up 16.9% year over year. COMEX registered inventory sits at 81.2 million ounces and has been declining for 6 consecutive years. The global silver supply deficit is entering its 6th consecutive year, and the February CPI report does not yet contain a single data point from the oil shock that is building the forward inflation picture in real time. The paper price moved today. The physical reality did not. BlackRock just confirmed what the physical supply chain has been signaling for months. In institutional language, for billion-dollar clients, on the same day the paper market dropped 3.95% on backward-looking inflation data. 2 messages, same market, same Wednesday, 2 different audiences. The direction of convergence between those 2 messages is not guaranteed on any specific timeline, but the data on which the structural case rests has not changed because of today's CPI print. This is financial warfare education, not advice. Pull the BlackRock analysis yourself. It is publicly available on BlackRock's institutional research platform. Check the COMEX warehouse report. Watch the physical dealer premiums. And never confuse a paper price moving on algorithmic leverage mechanics with the structural forces that determine where this metal goes when the paper and physical markets are eventually forced to speak to each other. Drop OG John AG in the comments and tell me, does today's paper price drop change your view on the structural thesis, or does it look like exactly what BlackRock is describing it as? I am reading every single comment. OG out.